What's up, traders? So today I'm going to show you two different option trades that I plan on making on Nvidia prior to their upcoming earnings on February 26th. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market, and I use the money I make from the stock market in order to pay for my entire lifestyle. But before we get started, I want to highlight one of the members in my community. Their name is Tony, but every single week we share our wins and our lessons, and I just want to highlight the amazing progress that Tony is making. And so in the first part of the paragraph, she's kind of highlighting some of the positions that we're in currently. And I do have to blur that out because that's only for the members of the community. However, you can see at the bottom here, she says all positions expire on February 28th. If all continues as planned, I will have an almost $3,500 month when I add in the other wins from earlier in the month, achieving my $3,000 goal. I plan to up the ante each month by setting a higher goal. And I simply responded to her within the community, just congratulating her on her wins and for her using the stock market how we intend to by using it as our own personal money printer. And I share my wins as well within the community, but I don't know, just being part of someone else's win makes me feel even better. I just want to see people replace their 9-to-5 income with money from the stock market. And now that Tony's doing $3,500 per month, I mean, I don't know how much she's making from her 9-to-5, but I'm assuming she could probably surpass it sometime within this year. So Tony, shout out to you. But people, as always, make sure you like this video and subscribe to the channel. And this is just a quick reminder that I am not a financial advisor and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. All right, so I'm going to go ahead and show you two different option plays that I plan on making prior to Nvidia's earnings. Now, over 95% of the time, I am an option seller. And that's because I love reliable and consistent income. I love knowing how much I'll make this week and how much I'll make next week and how much I'll make the week after that. Okay, so for me personally, I know that I make roughly between 7 to 10K per week. And by using consistent and reliable strategies, I know that I can bring that in typically every single week. And that makes me feel good because I don't feel like I need to buy a call and just hope and pray that a stock skyrockets in order to make money from the stock market. Okay, so over 95% of the time, I am on the option selling side. So of course, I will show you an option selling strategy that I plan on using. However, on the other 5%, I do use option buying strategies every now and then. And so for my option buyers, I have something for you too. So make sure you stay till the end of the video. All right, but first off, let's talk about Nvidia. So Nvidia is currently $134 per share. I'm actually recording this over the weekend, but yesterday was a huge red day in the market. It was actually the biggest red day in 2025 thus far, but you can see Nvidia dropped 4%. And for me as an option seller, I love days like this. Why do I like days like this? Because I set myself up to make more money in the future. All right, on red days like this where everybody's scared and everybody's selling their stocks, I come in and make trades taking advantage of the fear. And it really just boils down to that old Warren Buffett saying, be greedy when others are fearful and be fearful when others are greedy. So on days like this, I get real greedy and I make a whole lot of money. But we'll get back to that in a second. All right, so Nvidia's market cap is currently roughly around $3.3 trillion. And of course, as we know, they have an upcoming earnings on February 26th. Now, when it comes to Nvidia's fundamentals, I mean, they're amazing. They're growing their revenue and earnings extremely well. So we can look at the past 5 years here. So in the year ending in January 2020, they did $10 billion in revenue. And then 2021, they did $16 billion, and then $26 billion, and then $26 billion again, and then $60 billion. And then we'll get the numbers for the year ending in January 2025 on their earnings date, but they're going to absolutely crush this $60 billion number. You can see for the last 3 quarters, they've been doing somewhere around $30 billion in revenue. So extreme growth. Now, if we look at analyst ratings, we can see the analysts collectively have the mean target as $176.95. They have a low target at $135, which it is below that as of right now. And then they have a high target of $220. So analysts collectively believe that Nvidia has a long runway ahead of it. All right, if we scroll down, we can see that there's currently 43 analysts covering the stock. And out of the 43, 37 say that it is currently a strong buy, 2 have it as a moderate buy, and then 4 have it as a hold. And now if we look at their earnings estimates, analysts are predicting 79 cents per share, which will be better than they had in any quarter previously. And you can see that for the last 4 quarters, Nvidia has beat earnings every single time. Now, before we begin talking about how I would trade Nvidia prior to their earnings, let me preference it by saying this. I am a long-term Nvidia bull. I believe that several years from now, Nvidia will be doing much better numbers than it's doing today. And with that being said, while I do believe that they'll have great numbers for their earnings, I have absolutely no idea how Nvidia's stock is going to move right after earnings. Not even Nvidia knows how Nvidia's stock is going to move right after earnings. And here's why. I have seen companies have the most amazing earnings and beat on revenue and beat on earnings and put out decent forward guidance, and their stock sell off right after earnings. And then I've also seen the reverse, where a stock misses on revenue, where a stock misses on earnings and has poor forward guidance, and for some reason their stock goes up. And what's the reason for that? Well, investors are humans, and humans are irrational creatures. We are irrational creatures, so sometimes a stock's price moves irrationally. So although I am bullish on Nvidia in the long term, do I believe or do I know that Nvidia's stock price will go up right after earnings? I don't. And I'm not going to sit here and pretend that I do. But what I'm going to do is put myself in position to benefit either in the short term or the long term. Because I believe in the company, I think in the worst case scenario, I just benefit in the long term. But if the stock price goes up after earnings, well, then I'll benefit in the short term as well. All right, and here's exactly what I mean. So we can see Nvidia's last two earnings dates right here. We can see that they went down on both of them. But if we look right here at their last two earnings dates, which is the quarter ending October 24th, they beat earnings by 11%. And then the quarter ending July 24th, they beat earnings by 8.33%. So they did great. But guess what the stock did? Went down. And then on here, it went down, not as much as this one, but they both went down. Okay. And so we're irrational creatures. Now, if we look at 3 quarters ago, the quarter ending April of 24, they actually did smaller numbers than they did in the last 2 quarters, as you can see here. But after that earnings, the stock went up. All right, so over the long term, I absolutely believe that the stock price will continue to rise. What it will do the day after earnings, I have no idea, and I really don't care. But with that being said, let's get into our first strategy. So for my people on the selling side of options, the first thing we're going to do is we are going to sell puts. But if you're experienced with selling puts, make sure you stay and watch, because I'm going to show you a more efficient and better way to do it so you have a higher probability of profit. And then if you're an individual with a smaller account, make sure you stay, because I'll show you a way you can make a very similar trade with a very small account. All right, but the first thing we're going to do is we're going to sell a put. And when you're selling puts, the objective is 1, to generate income, and or to buy the underlying stock at a lower price. All right, and if you're familiar with the channel, you'll know that I use this analogy all the time, and I always compare selling puts to selling insurance, but it's for stocks. And here's what I mean. If you have a car, you probably have car insurance. And the reason you have car insurance is because you're fearful if you were to go out and drive that you could get into an accident. And if you do, you want the car insurance company to cover all the expenses. And so every month you pay your car insurance a premium to make sure that if you do get into that accident, that they cover all the expenses. Well, that is the exact same thing when you sell a put, except now you are the insurance company. All right, so say we have ABC stock that's currently trading for $100. We could come over and sell a put to the buyer at, let's say, $80. And we'll say to the buyer, hey, I will buy your shares of ABC stock from you if it crashes below $80, let's say in the next 2 weeks. But for insuring you, you have to pay me $300 up front. All right, so us as put sellers, we're agreeing to buy ABC stock at $80 if the stock price were to drop during the time that the contract is open. And we could set the contract for however long we want. So let's say it's 30 days out. So we're selling a contract for 30 days and we're receiving $300 for insuring ABC stock. Now from here, 2 things can happen. If ABC stock, which is currently at $100, stays above the $80 mark, we just keep the $300 that we received and we go about our day, and we can do the trade over and over and over again if we wish. And then the second thing that could happen is ABC stock drops below our $80 strike. Well, then we have to buy 100 shares of the company per contract that we have. However, we still get to keep that $300 premium that we received, just like your car insurance company keeps the premium that you pay them every month, whether you get into a car accident or you don't. All right, but in that case, if the stock price dropped below our $80 strike, then we have to buy 100 shares of ABC stock at that $80 mark that we agreed upon. But that's what makes selling puts so effective, is you have a high probability of profit, because as long as ABC stock just doesn't drop below the mark that you need it to, you just make money. All right, so if ABC stock goes up, make your money, go about your day. If ABC stock stays the same price, you make your money and go about your day. If ABC stock even were to drop a little bit, you still make your money and go about your day. It's not till it drops below your strike that you need to buy the shares. However, if you're doing this on a company that you actually like and that you actually believe in the long term, then you don't care either way. Like, I've been selling puts on Nvidia at lower prices, and I could care less where Nvidia's stock price is day to day, because I'm either going to get paid to wait around, or I'm going to get paid to buy a company that I actually like and actually believe in at a lower price than it was trading for when I first looked at it. So for me, that's a win-win. So let's go ahead and head over to Thinkorswim so I can show you the data points that I look at in order to select the best strike price. But really quickly, if you know anybody that you think could benefit from joining the Trader Freedom community, they'll not only get my exact trades as soon as I enter them, but they'll also get my entire options framework via the Trader Freedom course. And then thirdly, they'll be within a community of other traders that all have the exact same goals as them. So if you know anybody that needs to dive deeper into these strategies in order to generate income off the cash that they have, please tell them about the community. We even have 0 DTE strategies for the day traders out there, all the way up to monthly income strategies for the people that are more busy. So tell them about the Trader Freedom community. The link is in the description below. But here we are in Thinkorswim, and I have Nvidia pulled up. But the first thing we need to do is select our expiration date. And because Nvidia has earnings this week, there is an increase in implied volatility. And when there's an increase in implied volatility, that means us as option sellers receive more premium, because there's more fear in the market. All right, so me as an option seller, I want to take advantage of this. So I'm going to select the expiration date of this Friday. It's Friday, which is currently 6 days out. So I'll go ahead and click it. All right, so the first data point that I want to look at in order to select my best strike, especially because they have earnings coming up, is the expected move. All right, so if we come all the way over here, you can see this plus or minus number here, but it says plus or minus $13.33. So that is the expected move for Nvidia. So it's saying that Nvidia could possibly go up $13.33 and it could possibly go down $13.33. But that's just the move that the option market currently has priced in. And so since I'm selling a put, what I want to do is take the current price of Nvidia, which is $134, and subtract the $13 expected move from it. So that will put us at a strike of about $121. All right, so if we come over here to the strike of $121, we can see that it has a delta of 0.18. Now, delta will be the second data point that I would want to look at. And so by definition, delta is just how much an options premium will move per a $1 move in the underlying stock's price. All right, so that's good info. However, most successful traders that I know look at delta as the probability of an event occurring. So at this 0.18 delta, it is saying that there's about an 18% chance that Nvidia's stock price, which is currently at $134, drops down to $121 by this expiration date. All right, so in other words, you have about an 82% probability of profit from selling this put. And that sounds good to me. So typically I stay under a delta of 0.20 now that I have a larger account. However, when I had a smaller account, I used to do deltas of up to 0.30, because typically when you have a smaller account, you have to take a little bit more risk than individuals with a larger account. But this 0.18 delta is under my threshold of 0.20, so that works out perfectly. And we're going to get paid good money because the implied volatility is currently high. So you can see here the bid and ask is between $1.72 and $1.77. And so for those new to options, that is the per share cost. However, every contract is worth 100 shares. So if you are using a selling strategy, you'll receive 100 times the amount that you see. All right, so if this says $1.72, and if I were to sell this put, I will receive about $172 per contract. All right, and that contract is us agreeing to buy Nvidia shares at $121 if Nvidia's stock price were to drop below our strike by the expiration date, which is this upcoming Friday. And you'll need to purchase 100 shares per contract that you have. All right, so upon opening this, we'll receive $172. And as long as Nvidia stock stays above $121, we just go about our day and keep our money and go about our lives. However, if it drops below 121, then we'll have to buy the shares. But we still keep the premium that we received. All right, and I'm willing to make this trade because I believe in Nvidia long term. So if we go ahead and click on this, we can see we have our trade loaded up. And if we go down here to the profit and loss chart, we can see this red line here is where Nvidia stock price is currently. And if you look at this number up here, we can see that if the stock price goes up, we just make our $172. If the stock price stays the same, we make our $172. If the stock price drops a little bit, we still make our $172. However, if it starts to drop below $121, that's when we will start to make less money here. And then our break even number is around $119. And then if Nvidia stock price drops further than that, then that is when you'll technically start to lose money on the trade. However, remember, you're only doing this if you are fine with purchasing the shares at $121. All right, but what if you're like, Rashad, I don't have an account that's large enough to buy 100 shares of Nvidia at $121. Well, that's fine. That's where leveraged ETFs can come into play. Now, if you're new to leveraged ETFs, a leveraged ETF is simply a stock that looks to follow a specific stock or sector and move 2 or 3 times the move of that stock or sector per day. So an example for Nvidia would be if Nvidia moves up 1% for a day, a leveraged ETF would look to move up 2 or 3% for the day. And the same would work in reverse. If Nvidia were to drop 1% for the day, then a leveraged ETF will look to move down 2 or 3% for the day. Now, as an option seller, the reason you would use leveraged ETFs is 1, because they pay out more premium because they're more volatile, and then 2, because the stock price is typically much cheaper than the stock or the sector that it follows. And so one of the leveraged ETFs that I use that follow Nvidia is ticker symbol NVDX. So we can see NVDX is currently $12.71, and it is a 2x leveraged ETF to Nvidia. So you can see that it moved about 2 times more than what Nvidia did yesterday. But we will make the exact same type of trade. We will come over here to this week's expiration date, and then we will look at the expected move, which is currently $2.47. And so if we subtract that from the current price of NVDX, which is $12.71, you would get roughly $10.20. All right, so I would come down here. So that will put us in the ballpark of either the $10.50 strike or the $10 strike. And you can see that they have deltas of 0.13 and 0.18. And since we did a 0.18 delta for the Nvidia shares, we might as well do the exact same thing for NVDX. But we can see that we will receive anywhere between $30 and $40 for selling these puts. So typically you can possibly get somewhere right in the middle. So let's say we get about $35 per contract. All right, so you would do the exact same thing. Go ahead and click it. Then you can set your premium to the midpoint at 35 cents. And if we scroll down, this is the exact same thing. As long as Nvidia stays above our strike of $10.50, we just make our $35 per contract and we go about our day. All right, so for people with smaller accounts, it's much easier to buy 100 shares of a stock that is $10.50 than it would be to buy 100 shares of a stock that is $121. That would only be $1,050 that you would have to pay for the shares of NVDX if it were to drop below your strike price by the end of the expiration date. All right, but that is the strategy I would use as an option seller. What would I do as an option buyer? For my buying strategy, I'm going to use a strategy called the poor man's covered call. Now, the objective of a poor man's covered call is to profit from a slow and steady rise in a stock price and to minimize the cost of a long call. And this is exactly how it will work. So suppose we have a stock that's currently trading for $25. What we could do is buy to open at a strike of $20 for 24 months out. All right, so remember, we only want to do this on stocks that we believe in the long term. For this, we will pay out $7.25, which if we times by 100 is $725. And then we'll simultaneously turn around and sell to open a strike of $30, which is above the current stock price for a shorter period of time, usually up to about a month out. And for that, we receive 75 cents, which means we will receive about $75 up front. All right, so the best case scenario here is for the stock price just to slowly rise over long periods of time, but to hopefully stay just slightly below whatever our short strike is. So in this case, it would be $30. So 1 month out from now, best case scenario is this stock would be $29.99. Because in that case, we still get to keep our long call, our leaps, and then our short call will expire worthless. So we just keep that $75 that we received. And then the following month, we could sell another call for an even higher strike. And then hopefully the long call just slowly continues to rise. And then every month we can continue to do that. But let me show you how this will work in Thinkorswim. All right, so now we're back in Thinkorswim and I have Nvidia pulled up again. But the first thing we need to do is buy our long call, which is our leaps. All right, so we want to go out to the furthest date possible. So that would be January 15th of 2027, which is currently 692 days out from now. All right, so I'll click on that and then we'll scroll down. Now, what we want to do is buy an in the money call. All right, so we are buying a strike that is at a lower price than what the current stock price is at $134. And the reason you want to do this is it still gives you the highest probability of profit. All right, people that come down here and buy way out of the money calls are just buying a lottery ticket. And you can look up any research article that you would like, but most people that do that lose money. And we're in the game of giving ourselves the highest probability of making money. And so when I'm buying a leaps, I typically buy anywhere between a 0.70 and a 0.80 delta. All right, so for the purposes of this video, let's just assume you want to go on the lower end of that, so you're paying less up front. So that will put us at this strike of $125, which is a delta of 0.70. And for this strike, we will pay anywhere between $4,000 and $4,500. So let's go ahead and click that. And let's just assume we'll get somewhere near the mid price, which would be $4,260. All right, so that is perfect. Now we need to come up and sell our short call. Now for this, I typically go with any date below 45 days. And the reason for this is because with option contracts, time value decays the fastest within the last 45 days of the contract. So when you're on the selling side, that is exactly what you want. And so let's come up here. Now the contract just needs to be within 45 days. So we can do this 41 days, we could do 34, 27, 20. It's totally up to us. We just want to be within 45 days. So I think I'm going to go here at this March 21st date, which is 27 days out from now. So I'll go ahead and click that, and then I'll scroll down. And for this, I want to go about a delta of 0.30, which will put us at this strike of about 148 or 149. But in order just to get a nice round number, let's go ahead and do the strike of 150. All right, that is a delta of 0.28, and we will receive anywhere between $345 to $370 right here up front for selling this contract. But since we're pairing it with the long call, what it'll do is lessen the amount that we're paying up front for the long call. So the long call by itself will be paying about $4,260. But now that we are adding this on, so we'll go ahead and click. And so at the mid price, we'll be paying about $3,900. All right, so that is great. Let's go ahead and scroll down. All right, so we can see that this red line here is where Nvidia's stock price is currently. So if the stock price were to continue to rise throughout, and make sure you pay attention to this P&L on the expiration date of the short call. But if Nvidia stock price continues to rise, then we will continue to increase our money all the way up to the $150 strike that we set. And we can see that if Nvidia is $150, on March 21st, we will receive $1,498 from this single trade, which is a great return within, 27 days. However, if Nvidia stock price continues to rise above the $150 strike, you can see that we're still making money. However, now we're making less money. And so the higher the Nvidia stock price goes, the less and less money that we will make. All right, but we continue to be profitable. We continue to be profitable, and we keep going. And this goes all the way up to about $180. And you can see even at 180, we still make about $955 from this trade. Now, there will be a point where you can actually start to lose money from Nvidia stock price going up too much. However, from this chart, you can see how high it would have to go before you start to lose money. All right, now that is on the bullish side, and this is a bullish strategy because why? We believe in Nvidia long term. However, if the stock price were to go down, then yes, you will start to lose money on this trade. All right, so here we are back at the red line. Nvidia stock price is currently $134. And as it goes down, you can see we're still profitable right here. However, once it crosses about $128, that's when we will start to lose money. All right, and so you can see it, the further we go down, the less and less money that we'll make. All right, but that will be the case for any bullish strategy, or even if you were just to own the shares. Obviously, if it goes down, then you lose money. But if that happens, then we keep all of that money that we receive from the short call, and we still own the Nvidia Leap for the next 2 years, and we could just wait for a nice rebound. And in the short term, as long as Nvidia stock price doesn't go down too far, we can continue to sell those short calls at that higher price and collect income from that. But all right, ladies and gentlemen, that's how I plan on trading Nvidia. Again, if you know anybody that you think could benefit from learning from me, then please tell them about the Trade to Freedom community. They'll get to see my trades, they'll get my full Trade to Freedom course, and they'll be within a community of other traders that all have the exact same goals as them. And the link is in the description below. You could just send it to them. And please make sure you like this video, subscribe to the channel, and I will see you guys in the next one. Peace.